When you buy a home, there are usually a few repairs to pay for. Buyers who want to take on a real fixer-upper might be facing the prospect of many projects. If this is the case for you, you may be considering an FHA 203K loan, also known as a mortgage rehab loan or Section 203K loan, which combines the financing for both the home's purchase and remodeling or repairs into a single loan. What is an FHA 203K loan? An FHA 203K loan is a mortgage product backed by the Federal Housing Administration that allows home buyers to borrow enough money to cover both the cost of the home and the price of necessary repairs, including labor and materials. Certain 203K loans may allow you to finance up to 6 months of mortgage payments. Note that the FHA does not lend the funds for 203K rehab loans. Rather, it provides financial protection to lenders that do. How does an FHA 203K loan work? A 203K renovation loan can be a 15 or 30-year fixed-rate mortgage or an adjustable-rate mortgage, ARM. The amount you can borrow depends on criteria such as credit rating and income. The total amount borrowed through 203K loans must be within FHA loan limits for the area in which the home is located. Generally, the most you can borrow for the loan is the lowest of the following: the FHA's maximum loan limit for the county where the property is located, a calculation involving the home's before value plus improvement costs, a calculation involving the home's after value, including the improvements. You can only obtain a 203K loan through an FHA-approved lender. HUD's lender list allows you to search for approved lenders offering FHA rehab loans in your area. Because the application process and requirements associated with this type of loan can be complex, confirm the lender you select has experience with 203K loans. If you opt for a 203K loan, they'll typically work with a licensed contractor to handle renovations. The contractor you work with should be familiar with this kind of loan, especially the payment schedule and requirements. Occasionally, a 203K loan borrower may also do some or all of the work themselves. However, this requires approval from the lender. FHA 203K loans also come with some other strings attached. For one, the work must be completed within 6 months after closing, depending on the scope of the project. The FHA limits the projects to structural alterations and reconstruction, and modernization and improvements to the home's function. Once the renovations are completed, you're required to provide a letter, and a HUD-approved consultant will conduct an evaluation of the work. You can find a consultant through your lender or on the FHA website. It's a good idea to consider different types of financing if you are anticipating minor repairs, since a 203K is better suited for major projects that are necessary to transform neglected properties into more habitable living spaces, says Bruce McClary, Senior Vice President at the nonprofit National Foundation for Credit Counseling in Washington, D.C. A 203K loan also offers solid refinance rates for cash-strapped homeowners who either can't or don't want to tap their home equity. FHA 203K loan requirements. The main restriction for an FHA 203K loan is that the borrower has to be the owner or occupant. Investors are not eligible for this kind of loan, although in certain situations, nonprofit organizations may be allowed to obtain one. Other loan requirements include credit score, a minimum credit score of 500 or higher. Down payment, 3.5% minimum down payment or 10% if your credit score is below 580. Debt-to-income ratio, 43% to 45% maximum debt-to-income DTI ratio. Renovation costs. Cost of renovations must exceed $5,000 per standard 203K loan or be less than $35,000 for limited 203K loan. There are also minimum energy efficiency and structural standards that the project must meet in order to qualify. Types of FHA 203K loans. The FHA insures 2 types of 203K loans. Limited 203K. The limited 203K loan has an easier application process because it's for projects valued at less than $35,000. There is no minimum cost requirement, but you can't pay for structural repairs with this type of loan. Standard 203K. The standard 203K loan is for extensive jobs costing more than $35,000. The minimum loan amount for this type is $5,000. Structural changes like additions or full home renovations are permitted. The home buyer must obtain architectural exhibits and meet building codes. Eligible projects for FHA 203K loans. A standard 203K loan can cover many projects that increase your home's value. This is a partial list. Structural alterations and reconstruction. Modernization and improvements to the home's function. Elimination of health and safety hazards. Changes that improve appearance and eliminate obsolescence. Reconditioning or replacing plumbing, for example, installing a well and/or septic system. adding or replacing roofing, gutters, and downspouts, adding or replacing floors and slash or floor treatments, major landscape work and site improvements, enhancing accessibility for a disabled person, making energy conservation improvements. Work on certain kinds of properties, such as co-ops, is not allowed to be financed with a 203(k) loan. Mixed-use properties with both commercial and residential space may be eligible if the work being done is solely for residential usage. There are also projects that don't qualify for 203(k) financing. Basically, if the change doesn't result in a true upgrade, you can't use a 203(k) loan to pay for it. Luxury add-ons like swimming pools, hot tubs, tennis courts, and outdoor fireplaces aren't covered. FHA 203(k) loan pros and cons. Like any mortgage, there are advantages and disadvantages to an FHA renovation loan. Pros: one loan for both purchase and renovations. Low minimum down payment requirement. Relatively low credit score requirement. Potentially lower interest rates compared to personal loans, credit cards, or other home improvement loans. May finance up to 6 months of mortgage payments if the home can't be lived in during renovations. Cons: FHA mortgage insurance required. FHA loan rates may be higher compared to conventional loans. Process may require meeting with a 203(k) repair consultant. More extensive repairs require more paperwork. Potential for the additional cost of architectural assessments. Property must be your primary residence. Other ways to finance a home renovation. FHA 203(k) loans are one of several options to pay for home improvements, among the others. Cash out refinance. In this scenario, you borrow more than you owe on your existing mortgage and apply the proceeds to renovations. Cash out refinancing requires equity in your home. Home equity lines of credit. HELOCs come with one significant caveat. To borrow against your house, you must have plenty of home equity. Before considering a HELOC, make sure the value of your home is significantly higher than the amount you still owe on your mortgage. HELOCs usually close quickly and carry variable interest rates. Home equity loans. Essentially a second mortgage, a home equity loan comes with a fixed interest rate. As with a HELOC, you'll need sufficient equity. Financial technology company Renofi connects homeowners with credit unions willing to lend against the value of a home after improvements. Fannie Mae Homestyle or Freddie Mac Choice Renovation Loans. The Homestyle loan and choice renovation options also allow you to borrow against the future value of your home. Construction loan. A home construction loan is a short-term, higher-interest loan that provides the cash to pay the contractors. The property owner typically needs a longer-term mortgage after the work is completed. Personal loan. A personal loan is a fixed-rate product that can be used to finance home improvements. These loans don't require collateral, though you'll generally need good credit to qualify. Selling a stake in your home. A new breed of financial technology firms is pitching American homeowners on a different way of tapping into home equity. If you're sitting on a pile of it, these companies, including Haas, HomeTap, Point, and Unison, will buy a piece of your house. You repay the co-investment when you sell. One downside: this money comes at a higher cost than a mortgage or HELOC. FHA 203(k) loan refinancing. FHA 203(k) loans can be used both to purchase a fixer-upper or rehabilitate the home you already live in through a refinance. The process to refinance into a 203(k) loan is similar to a regular refinance, but you must meet the additional requirements of the 203(k) loan. After refinancing, a portion of the 203(k) proceeds will pay off your existing mortgage, and the rest of the money will be kept in escrow until repairs are completed. Existing 203(k) mortgages can also be refinanced through the FHA Streamline program, which may help you get an even lower interest rate.